Welcome to Talk Tickers. We're your shortcut for getting up to speed on the latest earnings calls.
Yep, and today we're diving into Capital One's first quarter results.
We've gone through the call, pulled out the highlights, the key numbers, and the strategy talk.
So let's get right into it. The headline number. First quarter net income was $1.4 billion.
Okay, $1.4 billion. And earnings per share.
Right, so that came out to $3.45 per diluted common share. But if you adjust for some legal reserve stuff and costs related to the Discover integration, it's actually $4.06 per share.
Got it. $4.06 adjusted.
Yeah.
And what about their core profitability before loan loss provisions?
Their pre-provision earnings, yeah. On an adjusted basis, that was basically flat compared to last quarter. Came in at $4.1 billion, actually up about 2% from Q4.
Okay, so stable there. But I saw revenue was down a bit.
It was, yeah, down 2% compared to the last quarter. But look, you got to remember Q1 just had 2 fewer days. That makes a difference on the top line.
Right. The day count effect.
Yeah.
Makes sense. Did they manage costs well?
They did. Adjusted non-interest expense dropped 5%. That was mostly lower marketing and operating expenses helping out.
Okay, good discipline there. What about credit? The provision for losses.
That came down too. The provision was $2.4 billion. That's $273 million less than the prior quarter.
And why was that lower? Fewer write-offs?
Exactly. Lower net charge-offs played a part, and they also released some of their reserves, about $368 million release from the allowance.
So where does that leave their total cushion for losses?
The total allowance balance is now $15.9 billion. The coverage ratio, so the allowance relative to total loans, dipped just slightly to 4.91%.
And their liquidity, how are they looking in terms of cash and liquid assets?
Very solid. Total liquidity reserves actually went up to $131 billion. That's about $7 billion higher than Q4.
Wow, okay.
Yeah, and their cash position ended around $49 billion. The preliminary liquidity coverage ratio, LCR, was strong at 152%.
152%. Very comfortable. Let's talk margins. Net interest margin, NIM. How did that fare?
Okay, so NIM was 6.93%. That is down 10 basis points from Q4.
Down 10 basis points.
But wait, remember the fewer days. If you adjust for that day count, NI actually increased by 5 basis points quarter over quarter.
Okay. So the underlying trend is actually positive there.
Right. And year over year, it's even better. NIM is up 24 basis points compared to Q1 last year.
That's a healthy jump.
Yeah.
And capital strength. CET1 ratio.
Ended the quarter at 13.6%. That's up about 10 basis points from the previous quarter. Solid footing.
Okay. Anything else on the headline numbers before we dig into the segments?
Oh, one interesting point on the dividend, especially with the Discover deal closing.
Yep.
So the record date for the second quarter dividend for both companies is expected to be after the May 18th closing.
Meaning?
Meaning current Discover shareholders will actually receive Capital One's $1.60 Q2 dividend, assuming the board approves it, of course.
Interesting detail for Discover shareholders there. Okay, let's break down the business units, starting with the big one, credit cards. How do they do?
Credit cards looked pretty good. You saw top-line growth, strong margins, and importantly, credit seems to be improving.
Okay, walk us through that. Purchase volume.
Purchase volume, so total spending on cards, was up 5% year over year.
Mm-hmm.
And if you adjust for the leap year day in Q1 2024, it was closer to 6% growth.
Right, and loan balances.
Ending loan balances grew $6.4 billion. That's about 4% year over year growth. Average loans were up about 5%, and that helped drive revenue up 7% for the card segment.
And the profitability on those loans, the revenue margin.
That saw a nice jump, up 37 basis points compared to last year, reaching 18.2%.
18.2%. What drove that increase?
A big factor was the end of that revenue sharing agreement they had with Walmart. That rolled off.
Gotcha. Now, credit quality within cards, charge-offs.
The charge-off rate was 6.19%. Now, that is up 25 basis points year over year.
Okay, so slightly higher losses.
But there's a key piece here. Remember the Walmart deal? The end of the loss sharing part of that agreement actually added 42 basis points to the charge-off rate. So if you strip that out.
Exactly. If you exclude that Walmart impact, the underlying charge-off rate would have been 5.77%. That's actually an improvement year over year.
So the core portfolio is performing better from a loss perspective than a year ago. That's important context.
Definitely. And delinquencies confirm that trend. They've been improving for several quarters now. The 30-plus day delinquency rate, seasonally adjusted, was down 23 basis points year over year.
Good signs on credit then. What about expenses in the card business?
Expenses were up. Non-interest expense rose 13% year over year. That was increases in both operating costs and marketing.
How much are they spending on marketing?
Marketing was $1.2 billion in the quarter. That's up 19% year over year, really focused on driving domestic card growth, getting new accounts, and attracting those heavy spenders.
Okay, makes sense. Let's shift over to consumer banking. That's auto loans, deposits, right?
That's right. And here, auto originations look strong, up 22% year over year.
22% jump in new auto loans. Wow. Yeah, leaning into that market a bit. Ending loan balances in consumer overall grew $3.8 billion, about 5% year over year.
And deposits, are they bringing in customer money?
They are. Ending and consumer deposits grew around 8%, and average deposits were up about 9%. Healthy growth there.
But revenue was down in this segment.
Yeah, revenue dipped about 2% year over year. That was mainly margin compression in their retail banking side. Growth in auto loans and deposits helped offset some of that, but not all.
And I think expenses were up quite a bit here, too.
They were. Adjusted non-interest expense jumped about 27% year over year. There was an adjusting item in there, but also reflects the higher auto originations, more marketing spend to build that national consumer bank, and tech investments.
Okay. What about credit quality in consumer, particularly auto?
Auto credit looks really good, actually. The charge-off rate was 1.55%. That's down a significant 44 basis points from last year.
Why such a big improvement?
It really reflects the actions they took back in 2022, tightening up credit standards when things looked a bit riskier. Those decisions are paying off now.
Makes sense. Delinquencies.
Also improving. The 30-plus day delinquency rate in auto was down 35 basis points year over year, again, seasonally adjusted.
Okay, so strong credit performance in auto. Now, quickly on commercial banking.
Commercial was pretty stable overall. Loan balances, both ending and average, were essentially flat compared to the previous quarter.
Deposits.
Ending deposits were down about 5% from Q4, but average deposits held roughly flat.
And financials. Revenue expenses.
Revenue was down 7% from the linked quarter. Non-interest expense was also down about 6%.
Credit and commercial. Usually pretty low losses there.
Yeah, it remained very strong. The annualized net charge-off rate actually fell 15 basis points from Q4 to just 0.11%. Very low.
Any signs of stress in commercial? Criticized loans.
The criticized performing loan rate ticked up just slightly by 6 basis points to 6.41%. But the criticized non-performing loan rate was basically flat at 1.4%. So still looking pretty contained.
Okay, thanks for that segment breakdown. Now, the big topic. The Discover acquisition.
Yeah.
What's the latest?
The headline news is they've got the regulatory approvals, all green lights. The deal is now expected to close on May 18th, so very soon.
May 18th. Okay. And are they sticking to their synergy estimates from when they announced the deal?
Yes, largely. They still expect to hit those synergy targets, cost savings, revenue uplift, with the full run rate achieved probably about 24 months after closing.
Any caveats there?
Well, one specific point they mentioned was about the network synergies. Their estimate assumes that the Fed's proposed lower debit interchange rates go into effect.
And if they don't?
If those lower rates don't happen, it would reduce the debit network synergy estimate by about $170 million. But importantly, it wouldn't change their future revenue because the debit business is moving to the Discover network anyway.
Got it. So the overall strategic idea hasn't changed.
Not at all. The goal is still creating this, leading consumer banking and payments platform, leveraging Capital One's tech across Discover's larger base and network. They're still very bullish on the long-term benefits.
Okay, let's zoom out a bit. What was management's take on the overall health of the U.S. consumer?
They painted a picture of continued resilience, really, pointing to low unemployment, solid job creation, stable real wages, still a source of strength for the economy.
And how is that translating into their own card portfolio?
They're seeing positive signs. Delinquency rates, as we discussed, are improving. Payment rates are actually up year over year.
But any signs of stress at all?
Yes, they did flag one thing. A portion of customers are making only the minimum payment at a rate that's still somewhat above pre-pandemic levels. So that suggests, some households might be feeling a bit more stretched.
Okay. And revolving balances, people carrying debt month to month.
That seems to have stabilized, but it's still below where it was before the pandemic. And importantly, the new accounts they're bringing on board, they're performing pretty much as expected, in line with historical trends pre-COVID.
What about spending patterns? Any shifts there?
Spending trends were pretty stable through Q1 overall, but they did note a recent little uptick in spend growth per customer.
Any idea why?
Could be a few things. Timing of Easter, maybe. Also, they saw increased retail spending on electronics, possibly. Possibly people buying ahead of potential tariff increases.
Interesting. Tariffs coming into play already. Anything else on spending?
Yeah, they mentioned some easing in the growth rate for travel and entertainment spending. Airfares in particular seem to have moderated a bit recently.
And in the auto market,
Yeah,
you mentioned strong originations.
right. And related to those tariffs again, early industry data might suggest some pull forward of auto purchases. People perhaps buying now to avoid potentially higher prices later. They're also seeing some signs that used car auction prices are rising a bit more than usual for this time of year.
Lots of moving parts influenced by the macro environment. Now, back to their own books, they released reserves this quarter. Why?
Primarily driven by that good credit performance we talked about. Delinquencies down, charge-offs adjusted, improving.
But they didn't release even more.
Well, they balanced that positive performance against a slightly worse outlook in their downside economic scenario. They're now factoring in potentially higher unemployment and maybe a return of inflation in that stress case, plus just adding a bit more for general uncertainty.
Okay, makes sense to be cautious. What about returning capital to shareholders? Dividends, buybacks.
The plan is to really assess the combined company's capital needs after the Discover deal closes, so post May 18th.
So no major changes immediately.
For Q2, at least, they expect the pace of capital return dividends, buybacks to stay pretty consistent, but they were clear. The intention is definitely to return excess capital once that analysis is done.
Good to know. Let's touch on marketing strategy. What are the main focuses?
It's kind of threefold. One, fuel overall customer growth. Two, really win at the top end of the market, attract those heavy spenders with premium cards. And three, continue building out their national bank brand.
How are they doing that?
A lot of it is data-driven, using analytics and modeling for more targeted offers. Big investments in the perks, too. Think the travel portal, the airport lounges, the Capital One shopping tool, trying to create a differentiated experience.
The marketing's extra important for their model.
Yeah, absolutely. As a more digital-first national bank with a relatively thin branch network, marketing is really key for reaching customers across the country and building that brand recognition.
Okay. Circling back to Discover integration. Synergies and technology, any more detail there?
Like we said, the synergy assumptions are holding steady, maybe just pushed out slightly time-wise because of the later close. The core strategic and financial logic is intact.
And the tech side, can Capital One handle integrating Discover's systems?
They seem confident. They highlighted their own 12-year tech transformation, moving to the cloud, building model platforms. They feel that gives them a strong base.
Well, Discover has older tech too, right? Mainframes.
Yeah, Discover has mainframes, data centers, but Capital One says they have experience managing that kind of infrastructure and, migrating things to the cloud over time.
What about the Discover network itself? That's new territory for Capital One.
Absolutely. That's a key focus. They acknowledge modernizing the Discover network will be a multi-year journey, but they also see a huge long-term opportunity there.
How so?
By potentially moving much more of Capital One's own transaction volume debit, eventually maybe even credit, onto the Discover network rails over time, more than they even initially modeled.
That would be significant. What's needed for that?
Building out international acceptance is key. And strengthening the Discover Global Network brand, that's the long game.
Okay, that leads nicely into the segment. This is not financial advice.
Our favorite part.
Right, just a thought experiment for you listening. Yeah. Given this huge focus on building out the Discover network, aiming for global scale.
Competing more directly with the big guys eventually.
Yeah, exactly. And knowing that payment networks often trade at different, sometimes higher valuation multiples than traditional banks. Here's a wild idea.
Uh-oh.
A potential highly speculative trade. Go long Capital One, maybe short a basket of established payment networks like Visa and MasterCard.
Ooh, bold. What's the thinking?
The thesis is, if AF Capital One pulls this off, after they successfully scale the Discover network globally, gain real traction, the market might eventually start valuing Capital One more like a payment network, potentially boosting its multiple.
And that gain could partly come at the expense of the incumbents if Discover takes share.
That's the speculative theory. If Discover becomes a stronger third or fourth network globally, it could potentially pressure Visa and MasterCard's dominance, or at least their valuation premiums.
Huge ifs in there, obviously. Building global network acceptance is incredibly hard.
Absolutely. Massive execution risk. It's a long-term play, years out. And again, totally speculative, not advice. Do your own research. But it's an interesting angle to consider given their stated ambitions.
It's definitely food for thought. Okay, so wrapping up our deep dive on Capital One's quarter.
Yeah, we covered the key numbers, solid adjusted earnings, improving credit trends, especially in cards and auto.
We looked at the segments, the upcoming Discover close on May 18th, and the big integration project ahead.
Plus, management's view on the consumer and those spending shifts, potentially driven by things like tariffs.
The focus on tech, the network potential, the capital return plans. Lots to track going forward.
Absolutely. We'll definitely keep monitoring how the Discover integration unfolds and how they execute on that network strategy.
It's certainly one of the more interesting stories in the financial space right now.
For sure. That's all the time we have for this deep dive on talk tickers. If you have follow-up questions or your own takes, feel free to reach out.
Thanks for tuning in.